Hello and welcome to SwitzerTV Investing. I'm Peter Switzer. On tonight's show we have some of the best stock pickers in the country giving us their views on some of their really hot stocks. These stocks are heavily swayed towards the tech sector, but we do look at some old standbys like Telstra. Is it a good buy at this low price, or should we be thinking about something a lot more modern than good old Telstra? We kick off with Julia Lee from Berman Invest. Then Michael Wayne of Medallion Financial gives us his 3 best stocks right now. I then get Jun Bei Liu of Tribeca Investment Partners to rate Michael's hot stocks, and then Paul Rickard looks at some of the big licks to see if they are still good investments in your overall portfolio. In case you don't know what a lick is, it's a listed investment company. Some of the big names like Argo were famous licks, and Paul will talk about whether these are still relevant and really good for your portfolio right now. So without any further ado, let's catch up with Julia Lee from Berman Invest. Well, we always kick off with Julia Lee from Berman Invest to see what she's liking right now. And a lot of our viewers liked the way that she liked Mesoblast before it took off again. So let's kick off with Mesoblast. Julia, how are you?
Good, how are you doing, Pete?
Very good. So what's the latest on Mesoblast?
Well, it's trading above $5 now, so hopefully some of your viewers got in at lower prices. But it has been a volatile road, and I do like to find stocks which have positive upcoming catalysts. And I think the big one for Mesoblast is the 30th of September, where it is due to get FDA approval or disapproval for its pediatric acute graft versus host. So watching that one closely, and I think part of that decision is de-risked somewhat by the oncology committee, which voted 9-1 in favor of the drug that Mesoblast has. But in addition to that, there are phase 3 trials ongoing with lower back pain as well as chronic heart failure, which are pretty exciting in the last quarter of the year. So looking at those as well and potential partnerships there. Okay,
so that's Mesoblast. Have you put any new stocks into your fund this week?
Last week we've been adding BlueScope Steel to the portfolio. We have seen steel prices in China recovering for a while now, but what's exciting is that steel prices in the US have been moving, and I guess that's symptomatic of economic recovery. But it's great that we are seeing strong demand there, which is causing prices to go up. So I think maybe the worst is behind BlueScope Steel, so happy to dip my toe into the water there.
And I guess, Julia, if you believe 2021 is going to be the year of infrastructure spending of governments right around the world, steel is always a part of infrastructure, isn't it?
It is. It's infrastructure, it's building, and it's even vehicles. So if we do see more people buying cars, then we could see some demand from the car industry.
Exactly right. Let's go through some of the stocks I've already run by experts in the program already. Companies like PointsBet. What's your view on PointsBet?
I think PointsBet has had a really good run, and it's one of those companies that has been benefiting from the COVID-19 situation. I think the acquisitions that they've made during this period will be quite sticky, so I do like the business. It has been quite volatile though, so in terms of price action now, I'd say there's a bit of froth in it. So as you see some of these stocks gaining in popularity, you have to be a lot more careful around the herding effect that happens as more people pile in, and I guess you go from just normal optimism to irrational exuberance in some of these valuations. So look, I like it when the herding effect takes place. I just become very careful in monitoring those positions so that when the share price does fall, that I'm not the last one to get out, because it can drop quite suddenly.
So Julia, what do you think of Megaport?
This is one we hold in our portfolio. Pete, you know I like data centers, and we've been holders of NextDC. And I guess Megaport is in the same vein, where we are seeing services or software to data centers becoming absolutely crucial. And Megaport connects not only different data centers to the user, but it allows users to move data to different data centers, to data center to data center. And I guess as cloud services become are a growing area and people connect to more than one data center. Something like Megaport, I think, has a good growth profile in front of it. So it is software instead of hardware, which is less expensive, and it just means that people can and businesses can bring on data capability and capacity as they need it quite quickly through a company like Megaport, which connects to, I think, something like 266 data centers in around 170 countries now.
Extraordinary. Let's go old-fashioned now, IAG.
Insurance Australia Group. When it comes to insurance, there's three things to evaluate: premiums, claims, and investment. So I guess having a look at the area of premiums, we are seeing price increases, which is good news for insurers. I guess the only thing that I'd be watching in terms of premiums is the employment situation. As stimulus starts to roll off, are we going to see more people without an income, and is that going to impact on how much insurance they buy in terms of their house insurance or their car insurance? In the area of claims, some of the claims areas have been lower, for example, in the area of vehicles, but that's been offset against expectations around future claims. This has to do with COVID-19 and I guess business disruption, as well as landlord and other insurance as well. So Insurance Australia Group has actually put aside about $100 million for that. It means that if they don't use all of that provisioning, that will be returned, and that would be a positive. But of course, if they use all that provisioning and need more, that would be a negative in the area of claims. So look, in the area of claims, you're probably seeing a slightly deteriorating outlook. And then finally is the area of investments, because basically insurers, they take your premiums and then they invest it either in things like bonds, fixed interest, or even in the share market. And if you think about the famous insurance company Berkshire Hathaway, that's really the underlying premise for Warren Buffett's business, that the insurance claims coming together and he invests the money. But in terms of Insurance Australia Group, those three areas: premiums, claims, and investment. Premiums, you're probably seeing a relatively positive outlook at the moment. Claims are relatively negative and deteriorating one. And in the area of investments, the investment values, of course, have been falling because interest rates around the globe have been falling. However, you're probably going to see a bit of stabilization over the next 12 months. And when you're looking at investments and insurers, the one that has the most exposure to an investment portfolio and earnings is QBE Insurance, followed by Insurance Australia Group on the market. Look, I don't mind Insurance Australia Group here. I'm probably slightly a bit more positive than neutral, but not a huge bull on this one.
Good analysis. Telstra?
Telstra. You know, Pete, every time
you've picked that right.
$3, I like it.
I know, you've picked it before.
And look, there's a reason why it's fallen below $3, and that's because of its weak outlook. They have given weak guidance for the current financial year. And look, that's understandable. We've seen COVID-19 impacts. We're not traveling overseas, so we're not using roaming services, and some of their mobile revenue has been a little bit softer than expected as well. But there's been a lot of talk that Telstra is becoming more and more like a retailer and a reseller of products because of NBN. And if you think along that retail line, retailers do really well when a hot new product is launched to the market. And the hot new product that I'm watching for Telstra is the iPhone 12. I've been holding off on upgrading my iPhone, even though it has a broken screen at the moment, because I want it to have 5G capability. So this new iPhone 12, which should be announced in October this year, will have 5G capacity. So I suspect there are a few iPhone owners which are waiting for the release of this one to make it, I guess, compatible with the future and 5G. And hopefully for Telstra, it means that they not only sell a whole bunch of iPhone 12s, but also their 5G capacity at the moment. So 5G has been rolled out to about 1/3 of the Australian population at the moment. And by 2025, it should be, by 2021, next year, June, it should be about 75% of the Australian population. So really with catalysts, often I'm looking for things like new management, new strategy, or new products. And for Telstra, the new products that I'm looking out for are 5G related products, which might boost sales.
And so is it a buy or a sell?
Yes, I like it under $3.
Okay, under $3. All right, now I've been bouncing for a lot of stocks. just quickly do Worley. A lot of people ask us about Worley. As you know, it's been a disappointing stock and it does well. What's its current position according to you?
Yeah, look, Worley Parsons, it's a changing company. Previously, they were pretty much reliant on the oil and gas industry. About 65% of their revenue came from that area. But then they made that Jacobs acquisition, which is in the chemicals sector. And so now about 20% of their revenue comes from that area. But having said that, if you have a look at the oil and gas space, they just haven't been spending as much on capital expenditure. In fact, if you have a look at the major companies, they've been guiding that they're spending around about 20 to 30% less. So I think that's still a negative for Worley Parsons, that oil and gas industry. But if you continue to see oil prices running up hard, then this will be a stock that benefits. But I suspect that, oil prices are going to probably linger around here for a while.
Okay, one last one. And it's one that's been popular and it's unpopular. It's a tricky company, Nearmap.
Yeah, Pete, I struggle with this one. I mean, we owned it in the portfolio and we sold it ahead of the capital raising, so we did quite well out of Nearmaps. But this is a company, I guess I like it because during lockdown, obviously you need services to be able to continue your workplace. So if you're a planner or a council worker or an architect, it allows you to do your work without actually having to go onto the site because there's very detailed images. Technology plays a huge part in this. And I guess the reason why I'm a little bit hesitant is because of the capital raising that they just did. They did a capital raising and this will allow them to scale much more quickly, which I think is a smart move given that time is of importance. But they've been guiding that they're getting to they're getting to a stage where the business should be doing well, and then it seems to go back 2 steps and then forward 3 steps and then back a couple of steps. So some of my confidence in what Nearmaps guides for has been eroded somewhat, and I suspect that's true of some other players in the market as well. So I think they have a bit more confidence building to do. If you're a high risk taker, maybe get in at this point, but for me, I'd prefer to see a bit more track record in terms of reliability of the things that they're guiding towards and achieving.
Well, the analysts think there's 30% upside, but as you pointed out, there are a few tricky moments in their business life ahead before that probably is materialised. Julia Lee, as always, thanks for joining us.
Thanks, Pete.
This episode was brought to you by WCM Investment Management, a California-based global equities manager with an outstanding long-term track record. This chart shows the significant outperformance of WCM's quality global growth strategy over the past 1 year, 3 years, 5 years, 10 years, and since its inception. Investors can access the strategy via the ASX with their choice of an exchange-traded managed fund, WCMQ, or a listed investment company, WQG.
Well, last week in the Switzer report, Michael Wayne wrote a brilliant article, very well received, about 3 stocks that he likes going forward. I want to talk to him about those 3 stocks and see why he likes them so much. Mike, great to see you.
Thanks for having me, Peter.
Yeah. Well, is it easy to find these sorts of stocks?
Well, it's hard because everyone's always asking for the next Afterpay these days, but to get returns like that in that time frame is very, very difficult. So what we try and do is find businesses that are going to capture the market's attention, capture a lot of market share within their various sectors, and hopefully do well off the back of that. But to get 10, 20 times your money in a couple of years, that's not
quite rare.
That's quite rare.
And do you accept that you might miss the early part of the rise in the share price because, in a sense, you need to see that the market's reinforcing your positive view on the company?
Yeah, 100%. You can't just look at the percentage return at the end of the day and say, look, it's gone from $1 to $10, look how well it's done. You've got to take into account the risk and the volatility. And it was only a couple of months ago that Afterpay went from $70 down to $8 in the matter of a few trading sessions. And that's a lot more volatility than you might get from your average ASX top 20 business or ASX top 50 business. So that's something you've got to take into account. not many people would have the stomach for something like that. So when you're weighting your portfolios or putting a certain amount to these companies, you need to take that into account.
I gotta say, my son tried to get in at $8 and his CommSec account actually froze. He's killing himself. All right, so let's talk about the companies you like. The one that a lot of people have heard about is Megaport. Why don't you just tell us why you like it?
Well, look, basically they're involved in data in many ways. It's different to a data center operator. Essentially, they're what they call a network as a service, which allows businesses which operate offshore and around the world to access different cloud networks when they need that capacity. They can vary the speed that they require, the capacity they need, the price, the contract length. So it essentially gives these businesses access to different data networks, whether it's Amazon's, Google's, and enables them to control that supply and that demand when they need it.
So in contrast, people who aren't using Megaport are basically always with one only provider?
That's right, and one form of data more often than not, whereas Megaport enables them to get access to all these different types of data and different data centres when they require it. The way we look at it is a bit like a roundabout. You can get on and off when you want, and it's that in essence when it comes to data. And because of their model, everyone likes that software as a service type model. This is in many ways a very similar model, it's just they call it network as a service. So you pay for when you need it.
So I guess the question is it a productivity play, or is it and therefore a cost reduction play, or is it something that actually enhances the success of someone's business when they have Megaport?
It's basically a productivity play. It enables these businesses to access different markets, store their data, use different types of data when they need it. Whereas in the past, they would have to have a fixed contract and a fixed amount of storage. Now they can tap into these markets and increase their access to that market or decrease their access whenever they need it.
So there'll be cost benefits as well?
That's right. It allows them to optimise their data usage from when they require it.
Does the market understand it?
Look, it sounds a bit more complex than it is, I think, in reality. We first included this in our monthly report 3 years ago, and it was around sort of $3 then.
Yeah.
It's actually come back into vogue, and it's starting to get a lot more attention now because the company's grown a lot, and everyone's thinking, oh, what are these businesses that are going to do well out of COVID? Obviously, we're demanding more data, access to more data in this environment, and this is one of the few companies on the ASX that will benefit from that change. So I think the awareness is starting to build. You've got more investment banks covering it, more research reports out there. So I think that you're sort of getting in just as the market's getting a better idea of what the business does.
Are you able to get a handle on how big the potential market is and what percentage they've got of it at this point in time?
Yeah, look, the numbers off the top of my head elude me, but it's an enormous market. And that's, I think, they're only just scratching the surface of it now. They've recently come up with a new product, which is half the reason it had such a big jump around the reporting season. A new arrangement in place with Amazon, which was a unique product, which is coming to the market for the first time. So that's meant to give them another big lift. But effectively, the market's very, very large, and they've only touched the surface so far.
Are they a takeover target?
Potentially.
When you hear the word Amazon, you think takeover, don't
Well, there's
you?
Amazon, there's IBM, there's all the different large industries that have the data centers, that have the data support structures. They basically are clients of Megaport. Who knows? I mean, at the moment, it's still a very small business in scale terms compared to some of those companies. So it is definitely conceivable.
Okay, let's go to the next one. Pushpay.
Yep.
What in the hell do they do?
Yeah, look, it sounds like an Afterpay or a Zip Money type company, but it's not really at all. Essentially, they provide a platform to faith-based organisations, mainly churches in the US, where they've got over 10,000 churches as customers. And effectively, it allows them to not only engage with their congregations a lot easier over the internet rather than in person, but it allows the congregations to provide donations through a platform. And effectively, Pushpay takes a clip of those donations. But for the churches, they actually love it because it increases their total amount of donations.
Makes it easy for
and
people
it makes
to donate.
it easier for people to donate as well. So they get the best of both worlds. Obviously, again, it's come to the fore during the lockdown when the number of people who were able to go to church at once has decreased. But this has forced people to look at other ways of collecting their donations, and PushPay's been in the right place at the right time. And I don't see that changing anytime soon. The awareness is now out there, and the fact is people will now look more likely migrate to PushPay rather than the old-fashioned collection plate.
Is this an Aussie company?
This is actually a New Zealand company, like a Xero, I suppose, and it's listed here and in New Zealand. And recently there's been a little bit of initial seed investor selling, but it's only really a small amount compared to how well they've actually done it.
Have the guys at Hillsong, are they using PushPay?
It is, it's all those sorts of things, as well as the big evangelicist churches where you end up with thousands of people packing out. So if you think about, again, the size of that market in the US, really at this point,
it's global, really.
It's global, and this is just they're focusing on churches at the moment, but then they could roll it out to charity-based organisations as well. Anything where you want to go up, you make your donation, you pay, rather than having to go through the conventional channels.
Maybe the Switzer report should use PushPay.
Well, the thing is, why they're different to, say, a Stripe or like some of those other, or even an Afterpay, for instance, is because they've actually got a platform which integrates the whole church-based and faith-based interaction with your congregation. So you get your sermons online, the calendar, everything like that is integrated into one hub. It's white labelled, and it's a big value add for these people.
Yeah, PointsBet. It sounds like complete opposite the PushPay.
PointsBet, look, it's not everyone's cup of tea because it's involved in sports betting and gambling. But we've been in it and done very well out of it, and we continue to like it. This is an Aussie company. So very big sports betting community in Australia here, but not so much in the US, because historically they've had regulations in place which limited the amount of sports betting that you're able to do. But in recent years, that's effectively all changed, and it's now been left up to the individual states to decide whether or not they want sports betting in their respective states. And all the states, well, not all the states, but a lot of the states, one by one, are coming online to sports betting. So you've had, Illinois, which is where Chicago is, New Jersey, Kansas City, the list goes on of all the different states that are now legalising sports betting. And PointsBet's actually one of the first movers into the US market.
Isn't 365 a US company? I've always presumed they were US.
Yeah, I'm not sure if they are. I think they could be. But there's lots of competition out there, don't get me wrong. There's William Hill, there's Bet360, Ladbrokes, but they've got 10% of the market share at the moment. In the US, PointsBet. They've got a lot of market share as well in Australia. But they've got a couple of different games, if you like, which are patented, and only they are able to provide it to their customers. So you can, for instance, set your bet depending on how many points you want your team to win by. If it's 1 point or whatever it is, your odds are then amplified. So that's actually a product which their competitors can't necessarily copy, which gives them a bit of an advantage. They've also got an agreement now with NBC over in the US, where NBC's coming on as a strategic partner. Effectively, PointsBet has agreed to spend $500 million on advertising on CNBC in return for a percentage.
NBC.
NBC.
Yeah, it's a bigger audience.
Not the business channel.
Yeah, that's right. So all these three companies, some people will watch this and say, right, well, Michael sees on these 3 years ago or whatever. Have they missed the boat?
Not necessarily, because early on you might miss out on those enormous gains, but as I was touching upon earlier, the risks are very different. These companies have now established themselves, they've got a lot of growth, they've won a lot of market share, they've got the funding in the bank, and they've got the backers to help them continue to expand and capitalise on that early advantage. So again, you can't just pile into tech names in your portfolio. You've got to make sure you've got a good balance there. But if you're looking for a couple of positions to jazz things up a little bit, these are businesses that have their risks, but I think it's a calculated risk.
And none of these would be top 300 even, would they?
I think Megaport might have slipped in there maybe just recently.
So they are takeover targets to a bigger company.
Definitely. And they'll be acquiring businesses themselves. They'll be growing organically, and they'll be picking off even smaller opportunities. And if you look at the likes of Amazon, Apple, all the companies, Alphabet, that are getting all the headlines at the moment because they're so huge and driving the direction of indices. Basically what's happening is more and more of the profits are going to fewer and fewer companies, because what ends up happening is these large established players who are listed on the market and have access to equity capital, they can go out and they can acquire their small competitors very early on. And that way they're effectively paying out for growth early, and then they expand as they integrate those new acquisitions.
Afterpay and Zip are doing exactly that.
Afterpay, Zip, this is sort of the way of the world at the moment in this tech space, because it is so scalable. If you've got that base in place, that infrastructure in place, you can leverage off that.
I think Jeff Bezos proved that a long time ago, didn't he?
And now look, if we can just get a tenth of what Jeff Bezos or a hundredth of what.
That's right. So that's Michael Wayne from Medallion Financial. If you want to read his extensive coverage on those three stocks, and you're not a Switzer Report subscriber, just take out a free trial of the Switzer Report and you can catch up on those insights from Michael Wayne. Thanks for joining us, mate.
Thanks, Peter.
This episode was brought to you by WCM Investment Management, a California-based global equities manager with an outstanding long-term track record. This chart shows the significant outperformance of WCM's quality global growth strategy over the past 1 year, 3 years, 5 years, 10 years, and since its inception. Investors can access the strategy via the ASX with their choice of an exchange-traded managed fund, WCMQ, or a listed investment company, WQG.
Well, every second week we catch up with Jun Bei Liu from Tribeca Investment Partners. Jun Bei Liu is a portfolio manager, and we always like to ask her what she likes right now. And we get her to check out some of the stocks that some of our other experts have said they like as well. Jun Bei Liu, great to see you.
Good to be here. Thank you, Peter.
My pleasure. Let's talk about the stocks that you like at the moment that's come up on your radar screen.
Oh my God, there's so many. There's so many. Let's go through the list. Look, the number one, well, the top five, I would say, is the first Sydney Airport. Yeah. Premium assets and something that will always retain its value over time. Yeah. You know, once we move truly beyond this lockdown and everything, and something that you know, with the lower interest rate, should retain a very premium asset value. So is Sydney Airport, and that you should generate significant amount of return, and that is our number one pick. Okay. And then we have the likes of Domain, you know, which is a growth asset that will deliver significant amount of return. It's probably one of the cheapest growth assets that is out there at the moment. Double-digit return, almost close to 100% over the next 2 years in terms of listings, property listing, and we all know how strong it has been, and we do believe there's a level of pent-up demand. Yeah. And
so you think there's good value because REA has dominated the market, but you're sort of suggesting Domain may well be the second player, but is a good second player and is underpriced.
Absolutely. Its market cap is only 1/7 of what REA is trading on. The real difference is really the Domain was the second player. You know, it's up and coming, and it's really just trying to monetize its audience base. And at the moment, it has the same access as the REA. So in our view, is that in 2 years, it should well get at least to half of what REA has achieved. So on that basis, the company is trading on very cheap, you know, sort of P to growth sort of ratio, which a lot of growth managers looking at. So probably one of the cheapest growth assets that is out there with leverage to the housing uplift.
Okay, that's number two. Number three?
Oh, there's plenty. So number three, so we got to be selective. So there's a Center Group we really like. Look, this is not a cup of tea for everyone. Our view is that with asset price, with the interest rate as low as it is, you know, premium asset as such as shopping centers or, you know, property and the like should be much higher than what it is right now. The reason it's only trading at 50% of its asset value is because it's being impacted by the coronavirus. So the retail shops were closed and shut and everything, but they will open, and it is on track to open. So we do believe that asset price will come back, and your return opportunity is enormous with this company. Yeah,
so all three stocks really have a reopening implication, don't they? You've got Sydney Airport, no travel, Domain when people start selling houses confidently again, and then of course you've got the implication of retail.
That's right, but there's one other ones that we will throw in is that even without reopening, Sonic Healthcare is an interesting one. It is one that often people say, oh, it's a boring stock, let's not go into it. But you know what? With the current amount of demand for coronavirus-related testing, even though the current normal level of testing for other related things that has been down significantly, but coronavirus has now more than compensated for that. And it's recently signed deals deals with the US government, which means current earnings is significant. It's something like 20% above what consensus is looking for at AGM. So this company is going to deliver a significant amount of return in the short term. Yes, in 2-3 years' time, it may come off, but for the short term, it is a good barbell strategy to hold in your portfolio.
Okay, they're your ones. Let me throw a few at you. What do you think of PointsBet?
I like PointsBet. I really think, it looks expensive. It's part of their growth strategy. But I think their latest deal with signing with, the marketing campaign and the equity raising give them the capacity and runway for the next 3 years. I really do think this company will capitalize on that betting in the US like none of the other companies in Australia you can gain exposure to, which I think is a really, really exciting space. So that is one absolutely I have.
What about Megaport?
I love Megaport compared to PointsBet. Megaport is actually more like an infrastructure sort of play. More telecommunication infrastructure, that cloud computing sort of play, generate a significant amount of growth in terms of runway, and that's the only company in Australia that provides that exposure to that cloud growth. And yes, it's expensive, but I think it's one of the very few that offers you that exposure to the space.
Now I'm going to ask you about a stock now where the analysts on FN Arena think there's 30% upside, but it's a company Nearmap. What's your view on Nearmap? Because it's been a checkered performer, hasn't it? Has a wonderful run up, then it gets sold off. I'm sure a lot of people out there just don't know what's going on with this company. What do you think?
Look, I, as you probably can tell from my previous commentary, I like growth companies, but Nearmap is one of those I loved what they have generated in terms of their growth, that they have gone into the US trying to grab that market share. But 6 months ago, or a little over 6 months ago, they started losing share to some of the smaller player within Australia. It does worry me a little bit that if you start losing share in your core market, what does that mean for your competitive advantage for the new market in the US? So I'm probably staying away from that company at this point. I do need to see more demonstration of its competitive advantage and how sustainable that is.
Okay. And what about a company like Lendlease? They own this building that we're in here right now. And of course, they've got all the rental challenges, but they are a diversified company. What's your view on Lendlease?
Yeah, I just feel they have too
Your
many
face
problems.
tells us the answer every time.
Too many problems. They have too many problems. Look, they managed to sell their part of their business, which is great. That's right, But they couldn't get rid of the Melbourne Metro, which has been the problem project for them. And there was expectations of the Victorian government kicking out some funding for them to hopefully get over that project, but it didn't happen. So look, it is a problem project for them, and look, it's very cheap. I'm kind of nowhere with that stock. I find it's very difficult for me to get on top of it. People tell me how complex it is. It's like the Macquarie Bank of the property trust. There are too many moving parts. And if you don't understand something, just wait for it.
Well, here's one that's pretty easy to understand, but be intriguing to see your reaction. And a lot of our viewers probably hold Telstra. What do you think? Your face again. You can tell straight away.
I think we spoke about it before.
Yeah, we have. I just wanted to see your face.
You always like to ask me those previous ex-market darlings. I actually think Telstra, they reported a little bit poor results. Look, if you're after dividend, it's okay. It offers a good dividend. It's over 5% dividend yield. Not much of a growth because the competition in mobile, which is meant to be the growth prospect for this company, is pretty intense. So I don't see that going away anytime soon with now that TPG and Vodafone merge and all of that. So dividend is okay, but don't expect any growth out of it. So I find it's a little bit boring, to be honest, to beat the market.
Well, I don't want to leave my viewers with a boring memory of Jun Bei Liu. So what do you think about SmartPay?
I like SmartPay, but I like Tyro better.
So do I.
So look, we have a we love Tyro since it listed. SmartPay is good. It's like the miniature version of Tyro, but SmartPay is kind of like a complete outsource model, which is lower cost and everything. But to me, I tend to like to stick with the market leader in any sector, any digital sector. You tend to want to stick with the market leader because these are the ones that will make it ultimately. SmartPay may well, but I just, we don't know, right? So Tyro is actually a great play for this reopening because their volume has really been impacted by the Victoria lockdown again.
22% of the economy is Victoria.
That's right. And now, but it's recovering again, even though with Victoria in lockdown. So I really think that is a business that will recover significantly. You generate significant amount of return from that business.
Well, I wrote a story today, Jun Bei Liu, and I just realised that as a shareholder of Tyro, I may well have a conflict of interest here because I suggested the Treasurer should reinstitute the long lunch, take away FBT. Imagine what would happen to Tyro's share price if everyone could take their business customers to lunch without FBT.
Especially in Victoria.
Especially in Victoria.
That's what we need.
Exactly right. Now, Jun Bei Liu, what's the name of your fund?
My fund is Tribeca Alpha Plus Fund, and we've been around since being over 13 years. It's been a long time. We've been one of the top performers in the Australian market, and we continue to see lots of opportunities across every sector, really.
Yeah. And as you can see, she goes after growth. That's Jun Bei Liu from Tribeca Investment Partners. Well, each week I like to catch up with Paul Rickard to see what he's written about in the Switzer report. And this week he's focused in on the big LICs. Now, if you don't know what a LIC is, it's a listed investment company. And some of the big names in the stock market like Argo and AFIC are these LICs. Paul's talked about now. Let's see if they're still relevant in the new age.
Well, they are, Peter. I mean, AFIC has something like 150,000 shareholders. Milton has about 90, the same with Argo. So these are really popular investments. AFIC's over $7 billion. And of course, they're largely investing in mainly blue chip type companies, Peter. Companies that can grow their dividends. And each of those three listed investment companies hopes to basically pay a fully franked dividend and give you roughly sort of index type performance.
What's the history of them, Paul?
Yeah, the history goes back. Milton was actually set up in 1953. I could be out by a couple of years, but it's in the 50s, I remember. Yeah. I don't know where they came from, Peter, but in the 80s and 90s, before we had things like exchange-traded funds and we all had more sort of, emphasis on managed funds, these listed investment companies were the easiest way to get, broad-based access to the stock market and was super popular, particularly companies like Argo had a really strong base in South Australia. So you talk to a lot of people in Adelaide, they've all got Argo shares. They grew up that way. I think Don Bradman was actually involved at some stage.
But you're right there, I think you're right.
Argo,
and Paul, I can remember as a young economist who inexplicably wasn't interested in the stock market, I remember when someone explained to me about this company called the Australian Foundation Investment Company, AFIC, and they had a big party over the North Shore and they introduced it to everybody. And at the time I thought, this seems like a pretty good way to get into the stock market if you're not an expert in the stock market. And so a lot of people did do that, didn't they? That it was a good vehicle to get involved in the stock market.
They've delivered for shareholders over the many, many years, Peter, and that's why they've got such a loyal shareholding. But occasionally they get very expensive and one of the challenges...
What do you mean by that?
One of the challenges with listed investment companies is that the price they're trading on the ASX often has very little relevance to the so-called underlying or intrinsic value. Now, because these listed investment companies just hold marketable securities, they're really easy to value and potentially they could sell all their investments tomorrow, pay off the small amount of liabilities and give you the money back. And we actually call that the intrinsic value, or it goes under the term NTA, standing for net tangible asset value. Now, that's a sort of a real value, but where they trade on the day on the ASX depends on just who wants to buy and who wants to sell.
Yeah, and this is the crazy part that a lot of normal people don't get. What you're saying is let's imagine they had 100 shares and each one of those shares was worth $1. The value of that company is $100, but the stock market could be saying, oh no, it's only worth 95 or 80. It's a discount then, or if I say it's worth 105, it's trading at a premium. But it's like the market's view can be wrong, really.
Yep, I mean, often the market just doesn't take account of it, or people don't really understand that. So you're right, a company can be worth $100 and it's only trading at the market value is at 90, or it could be trading at the market value is at 110. But if you came to liquidate it, which of course you can do with these companies because they just hold marketable securities as assets, you wouldn't get that back. So that's what we mean by premium and discount. And one of the challenges with listed investment companies is that you really need to pay close attention to the premium or discount. Now, my point about the three big major listed investment companies is the history says that sometimes they're at a premium and sometimes it says over a discount. And that has been true over not just the last 5 years, but the last multiple decades, 30, 40 years.
What are they now, Paul?
Well, the big ones have actually back at a bit of a premium.
Are they?
So I would argue that now's the time to actually think about selling them. And because they basically deliver sort of, historically they've delivered about index performance, you'd actually be better off buying the exchange traded funds. So in my article today, I sort of said AFIC is a sell, Argo's also a sell, and I would go into a couple of the big ETFs, probably VAS from Vanguard or IOZ from iShares. That's a better way to play the market.
An ETF that plays the market.
Basically, you're keeping almost identical exposure, and then when they go back out to a discount, go the other way. You get out of them and you get out of the ETF and go back into the listed investment company.
But Paul, some people buy into what look like good funds by good fund managers, and they're at a discount. And they seem to have difficulty closing the discount. Why? Why is it difficult to close it?
And that is one of the problems with the LIC market, Peter, and it's a challenge a lot of the smaller performing LICs. Generally, companies that are well run, well managed, good performance, well marketed, they tend to trade about NTA, right? And so often the smaller performing LICs that have, trading at a big discount, often you've got to look at behind the scenes and often the performance is not there. That's one of the issues. Sometimes the cost can be too high and sometimes they just get into that situation where no one loves them. And it's very hard to close the discount. And I think that's one of the reasons we are seeing some of the managers who've got listed investment companies in those situations think about what they're doing. We've seen a couple of proposals out there in the marketplace. But these big ones, Peter, for some reason, I can't work out why they trade at a premium.
Well, I think the answer is a lot of small retail traders like them, and because they like them, they buy them. But the other funds need advisors and other fund managers to buy in to get them to close that gap.
And when AFIC's trading at over a 7% premium, Peter, that's some of the easiest 7% I reckon you're ever going to make. You sell it, you buy VAS, you might have to wait 3 months or 6 months, you might even have to wait a couple of years. But at some stage, they'll go back into a discount and they'll be attractive buys again.
Okay, so if you want to know more about LICs, go and look at the Switzer report. If you're not a subscriber, there's a 21 free day trial. That's Paul Rickard from the Switzer report. And that's the show. Thanks for joining us. Next week, we'll be looking for more companies that we think is really good value for you and your investing.